Well, when I was a kid, I used to go door to door selling landscaping services, and I got 60 lawns in one weekend. I said, I probably could go door to door in industrial parks and find tenants for your buildings. The older guy, very loud, boisterous kind of guy, says, "You're hired!" They don't understand what a net lease is. They just want a full service lease. Managing a 10-unit building is really hard. I'm going to make a deal with one of those people on Industrial Drive who I've talked to 7 times. It's a relationship business, period.
What's going on, everybody? Welcome to another episode of the Commercial Real Estate Blueprint Podcast. I'm very excited for today's guest because he is a absolute beast in the asset class that me and Jesse are going after, industrial. He's bought over 100 buildings. He's sold over 80 of them. He's got 250 investors, and now he's not using debt, which is definitely interesting and kind of counterculture in a world where everybody's taking on a lot of leverage. So thank you so much for coming on the show, Joel Friedland.
Thanks, guys. It's great to be with you.
Yeah, absolutely. So you said you've been doing industrial real estate for over, I think you said 45 years, right?
Yeah. I graduated from college. I went to the University of Michigan. I knew I wanted to go into real estate. I just had no idea what end. And so when I graduated, I was looking for a job. I live in Chicago, and there was this family that, not my family, that had 84 industrial buildings, and they were looking for a property manager. And I applied. Not by sending a resume. I actually just called the guy. It was a guy in his 60s named Milt. And Milt was in business with his 2 sons and his daughter. They were in their 20s and 30s. And I called Milt, and he picks up the phone, and I said, "Hey, listen, I want to get into real estate, and I'd love to come see you." And he said, "Come over now." Literally. So I went to his office, which is right near O'Hare Airport. And I walked in the door, and I ended up meeting with Milt and his 2 sons and another guy that worked there. And I interviewed with them for 15 minutes. And they said, "Why should we hire you?" I said, "Well, tell me what your problems are." And they said, "Well, this was 1981. They said, we have 80 buildings and 10 of them are vacant. We need them filled." And I said, "Well, when I was a kid, I used to go door to door selling landscaping services, and I got 60 lawns in one weekend once." And I said, "I probably could go door to door in industrial parks and find tenants for your buildings." The older guy, very, very loud, boisterous kind of guy, says, "You're hired!" Just like that. And the sons are looking at him like, "Dad, you didn't consult us." He said, "This is the guy. We're sending him to industrial parks. He's going to lease our buildings." And I got in my car and I started driving around and stopping in at people's buildings. I'd walk in the front door, and if the front door was locked, I'd go in the back door.
That's incredible. So you did 2 things. You were into industrial before it was trendy, because right now it's kind of trendy. And then 2, you were like an original street broker. That's what they call it nowadays. People who go around and like walk up to people's docks and do canvassing. So that's absolutely awesome.
Yeah, that's exactly what I did. And I still do a lot of that. This summer, I had 9 summer interns, and we had canvassing door to door as part of what their activities were as an intern. Mm-hmm. And I sent them out in groups to different industrial parks, and they actually came up with people who were looking to sell and people who were looking to buy and a couple of tenants. And I actually went on one of the outings to go canvassing in a town called Elmhurst, and I brought all of them with me. And I said, "I'm going to talk my way into this space." We were in front of an industrial building. Mm-hmm. And I walked in and I said, "Hey, I've got these interns and we're learning about industrial real estate. Do you mind if they come in and meet you?" And he said, "Come on in." So all of us were in his office, and he was standing there explaining what they manufacture and about their 11,000 square feet. And he was great. So I said, "Let's do that one more time." I walked into the next place and I said, there's a man sitting at a desk, and I said, "I've got 9 interns. We're going canvassing to find leads for industrial real estate. Can I bring in these people and meet you?" And he said, "No, I'm very busy." And he's sitting behind a desk, and he's eating a sandwich. It must have been noon, sometime lunchtime. And he said, "I don't have time." I said, "Oh, come on. Can you just give us 5 minutes? It would be great. These young people are all college students. They would love it." I said no. So I opened the front door where they were all standing outside. I said, "Come on in." So
That's hilarious.
They filed into this guy's office, and he's still sitting at his desk, and he says, "I don't understand." I said no. I said, "Guys, this guy here, his name is Jeff. This is what it looks like to get thrown out. Jeff, are you throwing us out?" And he stands up and he comes at me like right up to my face. And I felt like, oh my God, I'm about to get punched right in the face. And I said, okay, we're leaving. And we left. And as we were walking out into the parking lot, my 9 interns were laughing hysterically. They had never seen anything like this. The 67-year-old guy and the 9 college students getting thrown out of a cold call.
That's hilarious. You basically showed them what it's like to be a broker, deal with rejection all the time.
Oh yeah.
Yes,
That's
exactly.
awesome. I'm curious, what was their script? Like, what did you tell them to say when you sent them on their own to these people? Like, because it sounds like you're trying to maximize potentially a sale, a buyer, and then a tenant.
Well, first of all, we carried flyers with us to hand off. And I would say 6 out of 7 times we couldn't get in to see the people. We were blocked by either a gatekeeper, receptionist, or something like that. And so we would drop off a flyer and say, this goes to, we knew the name of the owner of each company or the general manager of the branch. Mm-hmm. So we would say, this is for Bill. This is for Sue. And we would actually get calls the next day from dropping off these flyers. What they said wasn't really that important. It was just walking in and starting a conversation. And it started something like this. Hi, my name is Brandon, and I'm a summer intern. We own industrial buildings in the area. Are you looking to possibly move? Would you like to buy a building or lease a building? And then they'd be quiet and listen.
That's great advice. Yeah, I mean, it's always good to like you introduce yourself and then you just shut up, and that's what I try to do on the phone too. Like we'll cold call, ask them a couple of questions, get them talking, and then just let them go because they'll always reveal like not way more, but most of the time they'll reveal way more than what you would think.
Yeah.
And I showed them that they should have fun doing it. I have no accent. I'm not Hispanic and I'm not European, and I don't even know what accent is what, but I had them all sitting around and I said, I'm going to do a cold call and I'm going to show you how if I act totally idiotic and stupid, it still works as long as I feel confident and I connect with the person. So they're all sitting around the conference room table and I dial up a number and some guy answers because I was calling his mobile. We use Zoom Info. We have everybody's mobile number, literally everybody in the country that owns any kind of company. We've got it. So I call this guy up and his name's Marv. Hello, Marv. This is Joe. Joe calling about buying your building. Would you consider selling your building? And they're looking at me like, oh my God, this guy's a moron. He's crazy. And so Marv would say, oh, hello, Joe. You know, it's Joel is my name. But Joe, actually, I've never really thought about it. Why would you think I'm selling? And I said, oh, no, I don't think you're selling. I'm just thinking maybe you might one day. I'd overpay you for the building. I'll pay whatever you want. And like, whoa, well, it's not for sale. And say, okay, well, do you think anytime in the next couple of years you might sell? No, I don't think so. We're very happy here. No. And I'd say, oh, okay, I'll call you another time. Bye-bye. And then I'd hang up. And again, the 9 interns were hysterical laughing. Like, this guy's nuts. And they're looking at me.
That's hilarious.
And so, we have tremendous fun. It's really great.
Yeah. I think that's awesome. Because a lot of people take this business very seriously, which you should take the serious part serious, right? But having fun is definitely something that we try to do, and I feel like I'd say like most people don't, and so it's so unique.
Yeah, I also had them calling accountants and lawyers and other potential investors. So we're syndicators. I have 250 investors, and when we buy a building, since we use no debt, we have to raise all the money. So if we buy a building for $3 million. If my average investor is 50,000, I have to have 60 investors. So part of what they were doing was looking for potential syndication investors. That's a whole different kind of call, and you need a different level of credibility. And that's harder. So we had them doing a little bit of that. And I told them that if anyone who gets an investor to come in, you get a $3,000 bonus.
Oh, that's awesome.
Yeah. And anyone who finds a building that we buy, you get a $10,000 bonus. And I said, and since there's 9 of you, the one who finds it just is lucky. So the $10,000 bonus goes to the person who finds it, but all the rest of you get $1,000 if one of you guys finds a deal. So now everybody's on the same team.
That's amazing.
That's cool. Yeah.
Now, I was just going to say, how many buildings resulted from that strategy?
We got 1 last year from one of the interns, and we have 3 this year that we haven't bought yet. But we also found potential buyers and tenants for buildings that we own in the area. And we showed, one guy left a flyer, and the next day this fellow calls me and comes and sees the building. So there's not a lot that comes from it because in Chicago there's 17,000 industrial buildings, and unfortunately only 500 people move a year. So how do you figure out who the 500 are of the 17,000? It's mostly you're going to go to the 16,500 where nobody's going to do anything.
Yeah, it's definitely a needle in a haystack a lot of times that you're looking for these properties. I'm curious, when you guys are doing the canvassing, and I'm assuming this is generally how you guys look for properties, but if you're starting a conversation with, is there anything that you could buy? Like if they're looking for something to buy or if they're looking for something to lease, is that how you guys are really trying to kind of get in the door? What I mean is we call and we'll say like, hey, because we're brokers, hey, we have a buyer. But you guys are saying, hey, we own properties already. Do you have one? Like, are you guys trying to lease more space? You guys need more space? You're trying to buy more space? And is that an easier opening? Like, I'm just kind of like curious because are you going to be helping them by being a tenant rep for other properties, or are you guys just focused on your portfolio and finding more buildings and leasing them?
That's a great question. So I am still a broker and I still make deals as a tenant rep a lot. I do that. I have clients from all the years I've been doing this. Mm-hmm. And if somebody that I knock on their door, they say, oh, we are looking for 50,000 square feet. My pitch is really, I can help you find the 50,000 feet and negotiate a good deal because I've done a couple thousand leases as a broker representing tenants. So yes, that is a much less threatening thing than, hi, will you sell your building? Like, It's almost like a microaggression asking someone who you don't know. It's like going on a date. You're on a date and you go out to dinner for the first night and you look, I won't be crass, but you look at your date and you say, we're going to do it when we go home, right? On your first date. That's a microaggression. Like you will be left sitting at the table by yourself in most cases. And so you don't jump to what ultimately you may want to do in the beginning. You got to ease into it. So you're totally right, Jesse. The way we do it is we ask if they're looking to move, lease a building, or buy a building, as opposed to, will you sell your building? We try all of them. We do ask, will you sell your building? Mm-hmm. And occasionally it's okay, but usually it's of course not. Like, why are you even coming here? I'm very busy. I don't have time to talk to you about this. You haven't set the scene. Mm-hmm. But if it's, would you consider moving? We own buildings in the area, or we're a tenant rep. Yeah. That's an easier thing. It's not like punching at them, you know?
How do you know if like it's worth your time to be their tenant rep?
I've been doing it a long time. If it's a company that does something with manufacturing or distribution and they have a big enough place and they've been in business a long time, chances are good that most landlords would want them. I don't want to work with a fly-by-night company, and I don't work with little tiny companies. Mm-hmm. We don't have little tiny spaces. Our buildings are about 20,000 feet average. We have 100,000 feet. We've got 15,000 feet. And I'm not a flex guy. I don't believe in flex. I can't stand flex. I think it's a bunch of crap. And by the way, I say that not because other people shouldn't do it. It's just crap to me. Mm-hmm. After all these years, I don't want to be dealing with guys who fix lawnmowers. You know, a guy with 2 employees that's been in business for 2 years. I don't want to do that. Those are not credit tenants. Our buildings have credit tenants. They're bigger. We have people who've been in business a long time, and usually they're freestanding, not multi-tenant. And the reason I don't like flex is because you can't sell a flex building to a user. You can only sell it to an investor. So it's not that different from apartments.
Interesting.
It's similar to multifamily because it's based on a cap rate. I buy a building that's a freestanding building in an industrial park with 300 buildings in it. And if my tenant leaves, I can either lease it to another tenant or I can sell it to a user because there are very few user buildings on the market for sale or for lease that are freestanding. It has nothing to do with the cap rate. And the problem with flex for me is little tenants, bad credit, you're on a cap rate. And if the economy's bad and interest rates are high and cap rates are going up, you buy a building for $3 million, cap rates go up, it's only worth $2.5 million because the market's the market. But if I buy a $3 million user building that someone manufactures in and they move out, the next door neighbor or someone across the street that wants to own a building, they don't care about cap rates because the building is a tool for their business.
Yeah, that's amazing. That's also a big hot take right now. A lot of people probably, I'm sure you get into a lot of arguments about that. It's interesting because we started off buying the first building we ever bought was 6,000 square feet. And the primary motivation for buying that building wasn't anything smart. It was, hey, this building's 250 grand. We can buy that. And then
Yeah.
after that, we came across another seller who wanted to sell an 18,000 square foot building. We put that under contract and closed on it without a tenant, which wasn't the smartest thing, but we went for it. We thankfully got a tenant. And then we kind of came to the real, like, we basically built a small portfolio of exactly what you're talking about, like anywhere from 10,000 to 20,000 square foot single tenant buildings. And we've definitely had the temptation of, hey, let's pivot into small bay flex because it's less risky because you get multiple tenants across, 10 units, and maybe there's more turnover, but you're able to do shorter leases and increase the rates. But the user play is huge. And one of our mentors, who is very, very successful, said something very similar. He was like, my favorite asset class is 10,000 to 15,000 square foot industrial buildings, single tenant, because exactly what you said, you can buy them, you can lease them, you can turn around, flip them to owner users. And I feel like that's definitely a kind of a slept on strategy. And you've been doing it for 45 years. So that's awesome.
Yeah. I've bought approximately 100 single tenant buildings, and I bought approximately 8 multi-tenant buildings, which you might call flex today. We never call them flex. In the old days, if it was flex, it just meant it had too much office. And so we believe that the multi-tenant business is a fantastic business for someone who wants to be in it. When I say it's not good for me and I'm not going to do it, but I know people, there's a guy in Dallas, Chris Powers, who built up a multi-million-dollar portfolio of multi-tenant industrial buildings. Good for him. And I'm not against it. It's just not anything I want to have anything to do with. They're very, very labor intensive as far as management goes, because you have to cut the lawn, and you have to, if it's in a cold climate, plow the snow, and you have to worry about the arguments about who gets the parking spaces. I want those spaces. No, I want those spaces. And every little thing that goes wrong, you have to fix it. They don't understand what a net lease is. They just want a full service lease. And so managing a 10-unit building is really, really hard. We have one building with 3 tenants, and it's my biggest pain in the ass because there's always something going on where the tenants think because it's a multi-tenant building that we should take care of it and pay for it. Now, you go to one of our freestanding buildings. We have a building in Elmhurst that's on a street called Larch, Larch. It's 20,000 feet. And the tenant plows the snow, cuts the lawn, replaces the HVAC. It needed a new parking lot. It was his responsibility to put in the new parking lot, not ours. And he called and he said, hey, my lease has a year left on it. I don't want to put in the parking lot. If I renew my lease, will you guys split the cost of the parking lot with me? We said, yeah, that's fair. So it's a negotiation, at least, if the tenant's responsible for everything. But managing these single tenant buildings is a no hassle. It's still a lot. There's still a lot of accounting. There's still collections. We have to make sure we do take the roof and structure on almost all of them. Of the 25 buildings, the roof and structure is only being paid for by 3 tenants out of the 25 buildings. Because who wants to buy a new roof?
I was going to ask that if you have them on absolute net, because you said the guy was responsible for parking. So like when you say the roof and structure, that means, does that include the parking lot or not?
No.
Interesting. Okay.
No, it's the roof. So it's the steel that holds up the building, the bricks or the precast walls, and the roof membrane and the roof deck is ours. We recently walked away from a deal. I had to write an email to all my investors. We were raising $3.5 million to buy a building in a town here called Bensonville. We looked at the building. We love it. 21,000 feet. It's got 2 docks. It's got really nice office. The parking is outstanding. It's a great building. And the seller told us that he put a new roof on 5 years ago. And so we told all of our investors, we've got a building with a 5-year-old roof. Roofs are rated A through F on industrial buildings. So roofers all talk the same language. And we thought it would be an A- or a B+ since it's 5 years old and roofs should last for 15 to 20 years. So we go under contract. We put our $100,000 of earnest money in the title company, and we start doing our inspections. And my roofer calls my partner, Eric, and he says, this roof's a D. And Eric says, what? It's 5 years old. He says, no. They took a very old, bad roof, and they did a few repairs, and then they coated it with silver paint. And he said, what? Yeah, this isn't a new roof. This thing needs to be replaced. You're going to have to spend $300,000 on a new roof. And Eric calls me up. He says, I got really bad news. I said, well, that can't be right. The guy told us it was 5 years old. He says, well, the guy's a liar. So I called my favorite other roofer, Mel Fillins. I said, Mel, Joel, I need you on the roof at 300 Eastern tomorrow. And I need to know the roof. So he sends up his tech and he calls me in the afternoon. He says, Joel, this roof's a D. It's not 5 years old. They put some silver coating on it. And I'm going to send you the pictures of where it's cracking and coming apart because it's an old roof. And it's $300,000 to replace, and you're going to have to do it within 3 years. So now I've raised money. I put together my PPM, which is the offering document. All my investors have it. They're starting to say, I'm in, and ask me questions. And now I have to write them a letter. So I sent them this letter with the picture of the building with a big red X through it saying, we're not buying this building, with an explanation that we were misled on the roof. And we called the seller and said, we need you to put on a new roof or give us a discount. He says, I'm not giving you $1. You agreed to pay $3 million. No, I'm not giving you anything. I don't care what condition it's in. We said, but you told us it was new. He says, well, I thought it was.
Yeah, that's bad.
You thought it was. He knew it wasn't.
Yeah. What there's a saying is sellers are liars. And that happens. It really does. Curious why you kind of chose this asset class. Graham mentioned a little bit about our portfolio. We almost shy away from anything that's over 30,000 square foot. Do you think it has anything to do with the fact that it's Chicago and we're kind of maybe investing in more of a tertiary market, or like just trying to understand like why what got you to this point that you're investing in this kind of product?
Well, first of all, I agree with you. I love under 30,000 square feet. So I think you guys are really smart to do that.
Okay, cool.
And every time I've bought a bigger building, I've either made a lot of money by accident or lost a lot of money because the market changed or the tenant left. I don't like those big buildings. I was doing deals in multiple cities. I bought 200,000 square feet in Columbus, Ohio, and the tenant left during a very bad time in the economy back in 2010, and we got crushed. In fact, in 2008, I had so many problems that I went into literally a depression. I was in a clinical depression. I thought at the time I had 50 buildings, and I thought that I had lost everybody's money and that I'd be in the headlines of the Chicago business paper saying, Joel Friedland loses everybody's money. What an idiot. He bought too many buildings and put too much debt on. I came out of that very, very lucky because the market came back and my banks worked with me and I didn't lose everybody's money, but it was the hellish 5 years from 2008 to 2013. It couldn't have been worse. And I made the decision that you've made. I like under 30,000 feet. And that's why I do my deals with no debt now, because at my age, I don't want to lose money. And if you have debt, that's your biggest risk. You guys should. You're in your 20s and 30s. You should. And when I was in my 30s, man, I was buying stuff and borrowing money. I was like on fire. Millions of square feet of industrial, any size goes, 60% to 70% loan to value. I was like everybody else. And now, I got into this because I cold called Milt Podolsky when I was 22, and that's the business he was in. Mm-hmm. And they taught me the business. The five of them were my mentors. For 10 years, they taught me industrial, and I learned the market. And when I went and left, it wasn't because I didn't want to be there. It's because they wouldn't adopt me, and I couldn't be part of their family business.
Gotcha.
I'm curious, if you were to go recommend somebody to go start buying industrial, is 30,000 feet or less, is that what you would say? And then is there a minimum size, like 5,000 to 30, or do you do anything up to 30, or what would be the sweet spot?
So last year we bought 3 10,000 foot buildings. I like that size.
Yeah, me too.
So yes, I would say if you're backed by a pension fund or an institution, go buy big stuff because they put up 90% of the money and you put up 10%, and you can go make big deals and make a huge amount of money. You can make tens of millions of dollars buying big industrial buildings with the right capital partner. But if you're a syndicator and you're smaller and you don't want to lose money, that's why I like the under 30,000, because there's always, there's a funnel, right? We've got 20,000 industrial users here and 1.4 billion square feet. So our market is gigantic.
Yeah.
And at any given point in time, as I said, 500 people will move in a given year out of 17,000 buildings, out of 20,000 companies. So I want to own the buildings that more people want rather than the big ones that only Amazon and a few other really big companies want. Because if you're vacant with 800,000 square feet, you're not going to find a tenant as easily as you would for 10,000 or 20,000 square feet where there might be 30 buyers or tenants. Whereas 800,000 square feet, you might get one or two. And if they're one or two are not looking, or that your location's the wrong location, or your size is the wrong size, you're screwed. And that's why those guys do deals with institutions, because a pension fund putting $100 million into a deal is like us putting 50,000 into a deal. To them, it's just normal.
Yeah.
And so if you hook up with one of those pension funds, it's much easier to make the bigger deals. You're not taking that much risk. But when it's us, like you guys and like me, I'm a syndicator, I'm on the line, my investors count on me. I'm going to do deals where I know I can lease them or sell them.
I'm curious what, you obviously seem to know your market very well. We just did a podcast last week with Bob Knackel, and that's something he preaches. Know your data, don't be like a commodity, like know the numbers like the back of your hand. Seems like you do. I mean, I assume you do. You named a bunch of different statistics already. So if someone's going out and identifying a market to buy in, you mentioned Chicago's huge, and you mentioned a couple different towns, maybe, or counties. We're not familiar at all with Chicago. So, but what would be like a good geographic area? Like, how would you know if there's enough product there? If you should expand a little bit? Because we wrestle with that a lot. Like, should we focus on one city and do all kinds of different deals inside of it? Or should we go across the state and do just industrial?
Okay, I've got a really good answer for that. I call it the parking lot theory. You go to a shopping center and it's a very busy day before Christmas and it's hard to get a space. You got to find a parking space. You got to park far, far away because there's just people are using every parking space. So there's an aisle. Now, you can sit in that aisle and wait for someone to come out, or you can drive around and around and around and around and hope someone's going to come out while you're driving. Now, someone's going to come out into that aisle. If there's 80 spaces in the aisle, 40 on each side, and you're sitting there waiting for someone to come out, you see them come up that aisle, chances are pretty good that you're going to get a space in that aisle when they leave. If you're driving around and around and around, you got to get really lucky. So I think you're about 5 times more likely to find a space if you focus on one aisle. I look at it the same way. If there's an industrial street, we have an industrial street here in Elmhurst called Industrial Drive. It's better for me to know all of the 30 people very well and have talked to each one of them 7 times on Industrial Drive than to have maybe talked to someone once all around the whole Chicago area. Because I'm going to make a deal with one of those people on Industrial Drive who I've talked to 7 times. They know me. I know them. It's a relationship business. It's not a let's get lucky by cold calling one time and hoping that the one time we call is the one time they might sell. It's the relationship, period. And so there's this one street also called Oak Lawn in Elmhurst, and there's 4 buildings owned by one manufacturing company. 2 of them are next to each other, and then 2 of them are across the street next to each other. And the company that owns them, I have been into this guy's office at least 5 times, and my partner's been there at least 5 times. We know the guy, he knows us. I was driving down that street when my young guys were canvassing for the summer, and I saw this guy, he's Steve, and I saw him walking across the street from one building to another. I opened my window. He goes, "Hey, Joel." I go, "Hey, Steve, ready to sell the 4 buildings?" "No, we're not ready yet, but I'll let you know when we are." Now, am I better off knowing Steve with the 4 buildings, or am I better off going to some town that's like 40 miles away and knocking on doors and never, ever talking to anybody there again after the one time that I walked in and they said no?
Yeah, that's a great point. So I guess the follow-up question would be, how do you know if the one town has enough product to sustainably do that?
Well, I have a CRM. It's called Salesforce. And I know every building in every industrial park in Chicago under 30,000 square feet. You give me a town, I will tell you how many buildings there are in that town under 30,000 feet. I will tell you how big they are, who the tenant is, who the owner is, and everything about that town I have to know. I have to know. If my wife had pancreas cancer, and she survived it, and it's a very hard disease to survive. She had chemo, radiation, and surgery, and she's 2 years out. Let me ask you a question. Would I go to a doctor that does lots and lots of things. Like, hey, I'm a surgeon. I'm a general surgeon. Yeah, Joel, I took care of your hernia. Bring your wife in. I'll do the Whipple procedure. That I know it's really complicated, but I'll figure it out. Would you go to that doctor? And the answer is no. So we interviewed 5 medical teams, 1 in Milwaukee and 4 in Chicago before we picked a team. And the team we picked was a surgeon and an oncologist in Milwaukee. All they do is pancreas cancer, nothing else. They're experts in it. They're known for that. They have a foundation. They have a conference every year. And we pick them because you want to pick an expert because the expert knows and the other people don't know. And that's who you want to put your life in their hands. Well, finding buildings to buy is a lot less serious than finding a doctor, but you for sure have to be an expert in the market you work in. And if you're not, someone will eat your lunch. And if the market goes bad and all you were doing was guessing what the values were and you didn't really know, you're going to get crushed when something bad happens. So you got to know a market like cold. And my summer interns, their job at the end of the summer is we've got this big screen and we've got the internet, we go to Google Earth and we go to Industrial Drive in Elmhurst. And I say, Derek, I want you to go up and down the street and tell me every single building, how big it is, who the tenant is, who the owner is, and what they said. And I'll tell you what we do. If we can't get in, we do something drastic. We go buy a giant teddy bear and we bring the teddy bear with a message around its neck, an envelope that says, it's a real bear to sell your building if you don't sell it to Joel and Eric. And we bring it to the place and we say, is Will here? And Will's the owner of the building. What are you guys doing? Well, we have a gift for Will. Couldn't get in to see him. Bring him a giant teddy bear with a message. Think we get in to see him?
Yeah.
Yep, for sure.
Yeah.
That's the example about the doctors is like Bob Knackel basically said the exact same thing.
Yep.
He's great. He is so outstanding. I would say he's the best mentor in the country.
Wow.
Yeah. He's awesome. And the coolest thing is he's so humble too.
Definitely.
He's great.
Awesome. That definitely helps us. It's tough because we struggle with that. I feel like a lot of our beginning success was because we focused on one little market, and that's where we bought like 10 buildings in a row all in that market because we knew, okay, we think we can buy it for this and we can lease it for that. Mm-hmm. And we just rinsed and repeated over and over and over again. So that's definitely something interesting. But we've toyed with the idea of pivoting away from that market, but most of our portfolio is in that area. So would you think it'd be a bad idea to pivot if we didn't love that market? Or do you think we should stick in it?
For a little
well,
more,
I think
I want to add a little bit more color. For that county, there's 2,198 properties underneath 30,000 square foot that are industrial. I include flex on the Coast Harbor just because sometimes it's just wrong. But in High Point alone, on industrial properties under 30,000 square foot, there's 849 properties.
Yeah, I've been there, and I've been in the industrial area there. So I had a client who needed some leasing negotiations, and I went as a broker. And what I did is I drove around the market. Mm-hmm. So what I would say is I go street by street, town by town. The more you focus in, the more narrow you get, the better. So the second place to go is the place next to the place you've already been. And the next place to go is to the next place next to the next place that you went to second. And then you go to the next place third. When you have the whole market, because you've done enough years of it, then you can go from one market to the other. And what happens is that somebody who's in one town could move to the next town over. If you just are in the one town and not the one over, you're going to miss the opportunity. So I go in concentric circles around the place that's my main place. So the town of Elmhurst is right next door to a town called Bensonville. And the town of Bensonville is right next to a town called Elk Grove. And the town next to Elk Grove is right next to a town called Schiller Park and next to a town called Franklin Park. And I got all those towns. We've got those. But we didn't. 2 summers ago, when my wife was going through her treatments, I came to the office one day. We had 10 interns. And 2 of the guys were walking out of the office and they had a bunch of papers under their arms. And we were at the time working in a town called Wooddale, which is right next to Bensonville, which is right next to Elmhurst, which is right next to Itasca. I mean, you need to know like the area that well. And I said, where are you guys going? And they said, Melrose Park. No, you're not. And I hadn't been there for days and I couldn't figure it out. And the person running the program was my partner, Eric. And I went in and I said, "What are you doing? Why are they going to Melrose Park?" He said, "Well, we haven't been there yet." And I said, "Yeah, I wish I was working here every day instead of being at the hospital because I wouldn't let them step foot in Melrose Park. We're diluting our efforts that way. They should go to the next town over from Elmhurst, not Melrose Park." Melrose Park's 2 towns over. And Melrose Park is in the wrong county. So we have a county here west of O'Hare Airport called DuPage. The taxes are half as much as they are in where Chicago is, in the suburbs near Chicago. That's called Cook County. I don't want to buy any buildings in the suburbs of Cook County. The taxes are double. So Melrose Park's in Cook County. So they're going to a place that's not next door, where we don't know anybody, and where the taxes are twice as much. Why would I pay a bunch of guys $20 an hour to go to a place where I have no intention of ever buying a building?
Yeah, that's a good point. Curious about the tax thing. Like if it's technically in the TICAM, do you still see that as a big downside? I guess maybe because it's passed on to the tenant and it's more expensive to the tenant.
Yeah, and when the tenant leaves, your net rent's got to be lower in order for them to pay the same gross rent that it would be in the next county over. Tenants pay based on gross rent, not net rent. Because you could be in Cook County and the net rent might be $5 with the taxes being $5. If the taxes are $2, you're getting $8 net. So the building's worth twice as much money, more or less, if you're looking at returns in DuPage County, which is where the taxes are lower. So I'm sure you guys have similar situations. There's factors that make buildings worth more in a particular location than in a different one. You take the same exact building and you pick it up and you move it to the wrong place. It's the wrong place.
For sure.
Yeah, I never heard it said that way. Where they're paying off the gross rent, because everybody wants triple net leases and stuff like that, but you got to factor that for what gross would be. I just hadn't really heard it said specifically that way. That's cool.
Yeah, I've been doing it a long time. My main thing now is my investor relationships. I had a couple that live in Omaha, Nebraska, come into town Monday. He calls me up a few weeks ago. He says, "I'm coming to watch the Cubs play the Dodgers in 2 Monday nights from now." And they've invested, I think, in maybe 15 of my buildings and have $1 million with me. And I've never met them in person. So it's Norm and Susie. I've talked to them on the phone. We've done dozens and dozens of emails. And I said, you have to have lunch with me when you're in town before you go to the Cubs game that night. He said, "Oh, we'd love to." And I said, "Not only that, I'm going to take you on a tour of a bunch of our buildings. We'll pick a restaurant near where some of the buildings are that you own with me." And he came into town. We had the nicest afternoon. Susie's great. Norm's great. They're older. He's a retired dentist. He had a dentistry practice in Omaha, and I think he had like 17 dentists in the office, and he sold the practice. And he's retired now, and he lives on income from his investments. And my stuff is so low debt that it's really, really safe for them. And they never met me. We had the greatest time. It was so much fun. We went to a Greek restaurant. We then went on a ride, and I introduced him to a bunch of the tenants, and he saw what they did and shook their hands. I love the investor relations side of the syndication business.
That's really cool. I'm curious, for somebody starting out or like in our position, everything we've done so far has been like either 1031s or like one investor who's like a family, like friends and family, basically. So very small scale, like bootstraps stuff. I think the most expensive property we bought has been $1.2 million. So
I love that. Yeah. I love that.
Yeah. I mean, we like it too, and it's been really good to us. Do you recommend going into syndicating and trying to scale, or like how do we scale? Because I feel like we're at the capacity now where we get a good bit of deal flow, and we do have a lot of people who said they're willing to be investing with us. But we want to, we have a saying, we're trying to change our life, right? We're trying to continually buy deals and build cash flow. So like, what would you say?
So what are your documents when you have one investor? Who makes the decisions, you or them?
We just treat it like a regular partnership. So we have an operating agreement.
Okay. But I'm asking about something totally different. I know there's always an operating agreement. Who decides the 4 major decisions? So there's 4 major decisions in every deal. One is whether you're going to sell, whether you're going to lease, whether you're going to finance and what the terms are, in any major expense. So when you bring in a partner, do you guys run it and tell them what you're doing and they just have to agree to it? Or do you have to call them and ask their permission to do things?
We, for the most, I would say like almost everything we would make the decision on.
Is that what the operating agreement says?
I don't. That's a good question, honestly.
Okay, so what you need to do, this is the mistake that a lot of young guys make, and it's a mistake that I made. If you don't know your documents and know the terms of your agreement with people, I'm not going to say it's fucking stupid, but it's really stupid. And young guys don't do it because you're not a lawyer and you're not a document reader, and it's boring as hell, and it's more fun to buy stuff. But if you don't know your own agreements and you can't answer the question, if someone asks you on every single line of your agreement, you're not ready for prime time. You can't do it. You have to really get educated about the documents. And anyone who's been in business a long time will tell you a guy in his 30s and a guy in his 20s who are just getting started, no one would expect you to have that approach. Mm-hmm. I'm telling you guys, you better get that approach.
Got it.
Yeah, no, absolutely.
That's my mentorship to you. Yesterday, one of my investors who's, I don't know, maybe he's got $500,000 with me in 6 deals. So like, 100,000 or 80,000 average per deal, is looking at putting 100,000 into 2 of my deals each. So 200 total. And my documents are in a PPM, which is a private placement memorandum that looks like this. And this is 51 pages. You point to any page in this thing, I don't care what page it is. You ask me a question, I know the answer, period. So he sent me an email with like 14 questions, and his wife had 3 other questions. And without even having to look at the book, I could tell you section 2.2.1 on page 47 is the answer to that question. Here's the answer. This is what it is. And on page 6, it also has the same thing, but it's a little more clearly written. And I don't even have to look at the book to tell them what pages they are and what the answers are. So you guys need to do that next. Yeah. There's nothing more important. It's like studying for a test in school. If you can't say what your agreement says and you aren't sure, it's like getting an F on a paper. You can't run a business that way. And my problem is I did it your way while I was buying I bought 50 buildings, and I raised $100 million before I really knew my documents. Wow. So I was a stupid fucking idiot at age 31. And now I'm probably still one, but just in a different way. Mm-hmm. Not that way.
Yeah. No, that's great advice.
Yeah. Well, I was just gonna say, like, we talked a little bit before the podcast about challenges and stuff. I mean, what other challenges and mistakes did you run into that us young guys and anybody out there trying to get started needs to know?
The biggest thing is when you have a bad deal, you have to admit it right away. You can't hide it, and you can't play games, and you have to be really straight with people and let them know when something's wrong. And what I did up through 2008 is I painted a rosy picture because I believed it, because things never went bad. I had a few downturns and I had a couple bad deals, but the biggest problem is when you tell someone you've never lost money. The real problem is you just haven't lost money yet, because anyone who's doing lots of deals is going to lose money on something. So humility, knowing that things will go bad on something, and they will. And B, sharing the fact that losses happen and they cause lots of heartache and emotional turmoil, and being able to be vulnerable enough to talk about that and admit it and not be a big shot. Yeah, there's a couple of guys I've been watching on the internet on some of these podcasts and have done some things. And one of them says, we have never lost any money. That guy, he's probably doing something fraudulent. Who never lost money? Bernie Madoff. Do you know he never lost money? Of course he never lost money, because he wasn't being honest. Everything was a lie. Everything was bullshit. So people lose. Are you guys baseball fans?
Yeah, somewhat.
Is there any player that can say I've never struck out ever? Even the best players who have more home runs or more hits than anyone, they don't get up to bat and win every time. And no team in any sport wins every time. So that's the answer. Is the challenges are, you're going to lose and you're going to have to be vulnerable. And I have been, and it sucks. When there's a bad deal, it just sucks. But they happen. And I went through it, and I had to really come to people with just a tremendous amount of humility and say, this isn't working and we're having problems and I'm struggling.
Yeah, that's good. That's good. Humility's huge. That's really big. And that's definitely something I feel like that's in the back of every investor's mind. Like, you don't want something to go wrong, and you kind of have that, well, at least I do, like something could go wrong for sure at any moment. And so you try your best to make sure you're doing all the fundamentals that something won't go wrong, but you can't control. There's a lot of factors you can't control.
For sure.
Yeah. I open usually with an investor in 2008, I had 10 buildings out of 50 that were in trouble. I had 7 banks. I had $70 million worth of personal guarantees. And I was in a depression and had to go on medication and do meditation. And I couldn't get off the couch and I was a mess. And I really theoretically, I tell people this, I thought at times I've lost everything I've built up, or at least maybe I have, and I might be better off dead. And there's a lot of people who get in that terrible position and they have no vulnerability because they never have admitted that they've had a loss or that they've had a bad thing happen, and they kill themselves. And I was looking at, like, what pills could I take if I had to from my medicine cabinet if I wanted to die and not have to face telling people that I'm actually human and that things went bad. And when I open with that, the rest of the conversation is really easy.
Yeah, that's good. So how do you balance that? Like, you told us earlier we were younger, we should take on a lot of debt, we should go buy a bunch of buildings. Like, how do you balance like the fear of like something going south but also growing and pursuing building a portfolio?
It's really hard to balance growth and being conservative. It's really, really hard. And you have to figure out how to do it. And I think it requires mentorship. I've always had mentors, even now. I've got a guy who's 99 years old that's my biggest investor. And up until recently, I wouldn't do anything without laying it out for him exactly and saying, where's my risk? What do I do to protect us? What's the safety play here, even though this might be somewhat risky? And how do I position it? And he and I would talk it through, and I'd walk out of our Saturday morning breakfast feeling much more confident that if something does go wrong, we've structured it in a way where we can handle it.
That's good. Some mentorship and really laying out all the different blind spots that you could potentially have. So if and I've heard some people talk about this too, if you're looking at a deal and let's say that you're buying it vacant, you're going to probably over raise, I'd have to imagine, for the carry. I don't know. If you're buying it cash though, you don't have to worry about it as much though. So is it just like you promise less, and did you just try to over deliver? Is that kind of like the strategy a little bit sometimes?
No, it's never. Unfortunately, no deal's ever good enough to under promise and over deliver. When you buy a piece of property, you're always paying way too much, always, because the seller usually isn't stupid enough to give it away. So you're going to pay what the market is for a building. If you get one for under market and like you really steal it, which is maybe you might get that 1 out of 10 times, that's great. But for an ordinary deal, the contingency is I need to be able to carry the building vacant for at least 2 years, including paying for things that need to be fixed, taxes, insurance, utilities, and the mortgage. Because if you buy a building and it goes vacant and it stays vacant for a much longer time, what's your plan to fund the carry? And the answer is, if you're borrowing from a bank and you can't pay them what you owe them, give the keys back to the bank and lose all your money. So a lot of that's going on right now in multifamily all over the country, especially in the Sun Belt. Because these very optimistic guys who couldn't lose when the market was going up from 2012 until 21, they had floating rate debt. They put tons of debt on it. They were making money. They couldn't do anything wrong. And they didn't know what it was like to have trouble. This one guy out of Dallas just lost $400 million of his investors' money because he had never had a bad run. And when interest rates went up and he was floating and he had some vacancy and there was some overbuilding, he got in trouble. So how do you protect yourself from that scenario? And I have an idea, and the idea is you create a slush fund of dollars that can be used for any building that needs it when it's in trouble, instead of having to go to the bank. And what you do is you add that to each building. So it's like you're building your own insurance company for a bad deal. And if each building pays toward that and gives whoever you raise the money from interest on it, and you can use it, you've got to have, though, every investor in there has to be included on every decision, because otherwise slush funds become fraud. So you can't just use it any way you want. But if you have like $300,000 from a group of people and you say, if one of our deals goes bad, we can use this 300. Now it's going to go, it's sort of like you're creating your own preferred return deal where you're going to dilute the investors in that deal, but at least you're not going to lose it to the bank and end up having to literally fall into a depression because you're losing people's money. So I believe that that is a really important idea, but it's only one idea. But can you imagine if you just had a slush fund of a few $100,000 if one of your deals went bad to carry it? But then you have to tell the investors, if we need that money and we can't pony up our own money, we're going to have to pay for it.
Yeah. I mean, I think that's why we've been very bootstrapped, very, I would say, cautious about investor money, because we don't want to have a bad situation and we want to be working with people that understand kind of the deal, yes, but how to work through problems and work through them together, if that makes sense.
Yeah.
We want partners like that. So we're like very selective right now.
Yeah. The only people we partner with have been like very, very close, like basically more like business partners than investors. They add some kind of value to the deal. And so like they tell us that we make all the decisions, but there's certain aspects, like whether it's construction or whatever, that's their strong suit and they're kind of making the decisions on. So that's not an excuse for us not to know those documents.
True.
Something I
one last thing I want to tell you guys. My last deal, the one we didn't buy because the roof was crap, I put together an FAQ. I have 24 questions that I put into the PPM. That's a disclosure document to the investors. And let me just, I'll be happy to send it to you. I think you guys will love this. The investors really have a lot of questions, and I decided I'm going to answer all their questions before they ask. So I have something called 24 FAQs and frequently asked questions. The 24 of them. The first one is, what happens if the market crashes? The second one, what happens if our tenant leaves? You know, what happens if this and what? So I got all the negative things on one page early on in the materials. And the only way I could write it is if I answered the questions for myself, so that I knew that when I put them in for the investors to read it, that I actually thought it through. The problem is that most people don't think through what to do if something goes bad. They don't have a plan. They only have a plan if something goes good. And so I recommend that really highly. I'm happy to send it to you. I think you'll really get a kick out of it. These are like really tough questions. Like, all buildings have deficits. What's wrong with this one? Yeah. And in this case, the ceiling was too low. I said, well, it's 15 foot clear, and I wish we had 18 clear. And in another one, we only have one dock. Wish we had two docks that make the building less than what it could be. But admitting that it's not the perfect building and everything's not right isn't weakness, it's strength.
Yeah, no, that's a great point. I would love to see that. So yeah, definitely please send that to us.
Yeah, I'll shoot it over.
That would be awesome. I had a couple questions from earlier. One was, you talked about having 2 years of carrying costs, essentially, including potential CapEx. Is that something you're raising when you go buy a building? Are you raising all of that? Are you raising a little bit of it? Or are you not doing that at all? You just have the slush fund? That's question one, and I'll ask the other one after you answer that.
That's deal by deal. They're all different. If I do it with no debt and I raise a lot more money as reserves, you know what I do with the reserves? I invest the reserves and I make interest on it, and I pay that to the investors. So it just adds to their income, and I've got the money sitting there if we need it.
Interesting. Yeah. Okay. Do you have a general rule of thumb, though, like that you should raise like at least a little bit of a carrying cost, or do you?
Well, I have to have 2 years.
Gotcha. Okay. And then the other one is, you said you've bought, I think, well over 100 and you've sold 80. So that's something we ask a lot of these people, and everyone has a different opinion of, like us, for example. We bought several buildings. We've created a good amount of equity. Life-changing amount of equity for us, but it's in the buildings right now, so it's untouched. Should we sell some of our buildings or all of our buildings and take the money and reinvest in something else, and then also take our lessons, maybe de-risk a little bit and go on to the next thing? Or do we just hold those, let them sit, pay them down, and just keep doing what we're doing and kind of just buying more properties on top of that?
We could have a 1 hour podcast and discussion on that and still not have an answer. Everything depends on what you want to do. I have many people in my life that do what I do, who buy and sell, and they have a 5 to 7 year hold. I have a lot of people who flip. I have a lot of different things that people do. And in my case, we like to hold really long term. but it doesn't mean that's right. And if you hold really long term, your investors run out of money because you're not giving them anything back to reinvest. And you also don't make your promote if you hold too long, because the shorter you own it, the more your carried interest is as the sponsor. So there's a lot of issues there. We could do another one of these and go through just that subject and go through your buildings one by one. And the answer is really, I think you do a little bit of each, selling and keeping. And you figure out which are the keepers for sure because they're great specs and you couldn't replace a building and you love the way it's laid out.
Mm-hmm.
We don't sell those. But if there's one that's like, yeah, I kind of wanted to buy it and it's not perfect, and then I get a great offer, blah, 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 blah.
Yeah,
That's a great way to see it. That's kind of, I feel like, been a blended answer of what people have said. And something we've thought about is like, we haven't really raised money for any of these buildings except for like maybe a handful of them. And the people we did them with were friends/business partners, and they don't really want to sell. So like a lot of the argument to sell is to, like you said, get your investors their money back and then recycle it. But we're not necessarily in that position. And our goal is kind of cash flow.
Yeah.
So it's definitely something to think about.
It gets back to what I talked about, knowing every sentence in your documents and knowing what your rights are and what the objectives are of yourself and your investors, what they want to do when they first signed up, what you want to do and what the game plan is, and with the ability to change it if you want to change the game plan. But we have a plan in each time we buy a property. If it's one that I couldn't care less if we don't own it anymore in 5 years, we'll probably sell it. It might be a good deal to buy, but it might not be a good deal to keep. But I still have a building that we bought way before you guys were born, 35 years ago. I still have it, 20,000 square feet. And I still have a bunch of them that are just slightly younger than you, where we did them in 2002, 2003, 2004. I still have 12 buildings from 20 years ago and longer.
That's
That's
incredible.
awesome. That's amazing. Curious, how many tenants did you go through with some of those buildings?
Some of them have had one tenant the whole time.
I was curious. I was wondering. I was waiting for that answer.
Some of them have had two, and there's a couple of them where we've had like 5 tenants. We have one, I call it the disaster building.
Oh no.
We've had 5 tenants because 4 of them have gone out of business.
Oh no. Maybe you should sell that one.
Yeah. And it, by the way, it's 7,000 feet. Remember we talked about the smaller the tenant, the less creditworthy the tenant, the smaller the building.
Interesting.
So the reason that I like 20,000 feet and 15 and 17, the creditworthiness of tenants who can occupy 16 to 25 is very often different than the kind who can occupy 7 to 10. My only recent purchase where I have trouble with the tenant is 10,000 feet from last year. We bought 3 of them. And one of the, because these small tenants they're just not that strong. And the bigger tenants could be national companies with a local operation or a family-owned company where they're multimillionaires and they're never going to go out of business. But the disaster building has been rough. And I keep telling my co-owners on that we should sell it. And they keep saying, no, but it's a great building. Yeah, it's great. But we've had 4 tenants go out of business out of 5.
Yeah, that's good. That's really good. Definitely something like it's thinking way past just like what's the price per foot, what lease rate can we get. It's thinking like this, getting into the strength of the tenant. I mean, that's like, obviously that's important, but a lot of times you just maybe check their financials and it's a year or 2 back, but you're just thinking way more in depth, which is good.
Well, you guys are young. I started literally when I was younger than either of you. I was 22 when I went into industrial real estate. And when I first started buying, I was in between your ages. And yeah, you guys I admire what you're doing very, very much. You guys, and having the podcast and learning and buying buildings and having partners, you guys are doing everything right. You just need to focus on the details, because the biggest disaster you can have, the biggest problem you can have is your details get out of whack because you didn't pay attention to them because you think you're salesmen. And salesmen go broke and operators get rich. They don't get rich from being a salesman operator or a marketer. They get rich from being a really, really, really good operator, which means knowing your documents, knowing your buildings, knowing your plan for downside, managing the buildings really well, having a game plan, being on the same page with your investors. Those are the kinds of things that I hope when you're 35 and 40 and we talk again and you say, we listened to what you said and we are really, really well organized here and we learned just a shit ton of stuff we didn't know. Mm-hmm. If you guys can do that, you're going to feel really, really smart and really capable, and people will respect you beyond anything that you've seen.
That's awesome. Well, We appreciate those compliments a lot. Seriously.
Yeah, for sure.
And I'm definitely going to take the advice to heart.
Yes, because something we're battling now is we could talk more about this offline. We'll be cognizant of your time too. Is we are still brokers, and you've maintained your brokerage license, but we know the power of focus, just like you're saying. It's like we want to be on the principal side long term, and kind of dropping that brokerage and picking up the principal thing full time. It's hard to be a great operator when you're trying to do both.
Let's have that discussion another time because it's worthwhile, and
Yeah.
I can give you a lot of input on that.
Okay.
I have two different positions on it, and one is keep brokering, and the other one is stop. And neither one is necessarily right.
Yeah.
But I know that you could do either one, and I have done either one. I've done both, and I've done one or the other at various times.
Mm-hmm.
Let's talk about that one day. Let's make another time and what we can do this, and I think that would be another great thing that we could share with other people, the discussion, and they can hear us talk about it.
Okay.
Yeah, that'd be amazing. We'd love that. We'd love
Yeah.
that. Well, awesome. This has been a masterclass. I've learned a ton, and we appreciate it. And there's not a lot of people. There's a lot of people out there doing industrial, and there's a lot of people out there doing. I feel like most of them aren't just doing industrial. They're doing industrial and retail, or industrial and flex, or whatever it is, and they haven't been doing it for as long as you. So this has been a unique episode. I was very excited about it because it's the same space we're in.
Mm-hmm.
And I think industrial is a hot topic. So a lot of people will get a lot of value out of this, and we really, really appreciate your time.
Yes.
You guys, you're doing great. Keep it up. Get your details really, really straight over the next couple of years. I just have great admiration, and it's an honor to be with you guys. And when people watch this and listen to this, I think they'll get something from it.
Absolutely.
100%.
If people want to reach out to you and get connected with you, what's the best place for them to do it?
Our website is britproperties.com, BRIT with one T, properties.com. And we've got all kinds of stuff on there, just deal examples and articles and podcasts. And it's a website that we built to talk about why we do debt-free deals.
Awesome. I'm going to check that out. If you want to check out his stuff, go check out his website, reach out to him, say thank you for the episode. It was amazing.
Yes.
And we will see you guys in the next one. Thank you so much for listening.